This video is only for educational purposes. Imagine waking up on a Monday morning, thinking it's a normal trading day, only to watch the entire stock market collapse faster than anything you've ever seen in your life. Picture the S&P 500 dropping more than 20% in a single session. Picture the Dow Jones crashing by over 500 points when 500 points used to mean absolute panic. And picture global markets from the US to Europe to Asia falling one after another like a chain reaction no one could stop. That day wasn't a movie, and it wasn't a simulation. It was real. It was October 19th, 1987, the day the world experienced the fastest and most shocking global stock market crash in modern history, now known as Black Monday. In today's video, we're going to break this event down so simply that even a complete beginner will understand what really happened. We'll talk about what triggered the crash, how the markets reacted, why computers actually made the crash worse, what everyday investors went through, and how the lessons from 1987 still shape the way modern markets work today. By the end of this video, you'll understand why Black Monday matters, what it teaches beginners about risk, and how long-term thinking helped investors recover even from a day this extreme. So stay with me because the next few minutes will completely change the way you think about stock market history and market behavior. Welcome to Crypto Brain Power. This channel is all about making the stock market simple for beginners. We explore market history, break down major events, and explain how markets evolve over time so you can build long-term financial knowledge. Everything here is practical, educational, and easy to understand even if you're just getting started. Black Monday. The name alone sounds dramatic, and honestly, it deserves that reputation. To understand what happened, we need to start with what the stock market looked like before the crash. The US economy was doing well in the mid-1980s. Companies like Apple were still in their early growth stages. New technology was emerging, consumer spending was rising, and for several years leading up to 1987, the stock market was climbing almost nonstop. Investors were confident, maybe a little too confident, and that optimism pushed stocks to higher and higher valuations. But here's the important part. When markets climb too fast without taking a breath, the risk of a sharp pullback grows. Beginners often think rising prices mean everything is safe, but sometimes the opposite is true. By 1987, inflation concerns had started building. The Federal Reserve began raising interest rates, and global markets were showing signs of stress. Many investors ignored these warning signs because the momentum felt unstoppable. Then came the spark. On October 14, 1987, markets began to fall. Nothing extreme, just a noticeable decline. But behind the scenes, something was making this drop more dangerous. At the time, a strategy called portfolio insurance had become very popular. The idea was simple. If the market starts falling, computers would automatically sell stock index futures to reduce risk. It sounded smart, but millions of dollars were tied to this strategy. And every time the market dropped even a little, these automated systems triggered massive waves of selling. Now, imagine this. The market drops 1%, computers sell. The selling pushes the market down another 2%, so the computers sell even more. That selling pushes prices down even further, causing even more automatic selling. This became a loop. A dangerous, unstoppable cycle. And by Monday morning, this loop reached its breaking point. As the market opened on October 19th, panic spread instantly. Before investors could even react, the Dow Jones was plunging, not slowly, not gradually. It was falling at a speed people had never seen before. News reports couldn't keep up. Phone lines for trading firms were overwhelmed. Computers at the New York Stock Exchange struggled to process orders. And the selling pressure kept building with no relief. The Dow dropped 508 points, 22.6% in a single day. To understand how extreme that is, imagine the Dow falling more than 7,000 points today in just one session. That's the level of shock people felt. Global markets responded almost instantly. London's market fell. Tokyo's market fell. Markets in Australia, Canada, and many parts of Europe collapsed as well. It was the first time the entire world saw a truly global, synchronized crash happen in real time. For regular investors, the day was terrifying. Many who invested through platforms like Charles Schwab or Fidelity saw account balances vanish by the hour. Some tried to sell to protect themselves, but the markets were dropping so fast that trades could and even be executed at the prices people expected. This is one of the biggest mistakes beginners make, believing that selling in a panic will save them. In reality, selling when everyone else is panicking often locks in the worst possible losses. But here's the part most people forget about Black Monday: the recovery. While the crash was violent, the long-term outcome tells a very different story. The U.S. government and Federal Reserve stepped in quickly to reassure the financial system. The Fed announced it was ready to provide liquidity to stabilize markets. Confidence started returning. And within 2 years, the market had fully recovered. Long-term investors who stayed calm actually regained everything and eventually saw significant growth in the years that followed. This is one of the most important lessons from Black Monday. Markets can fall fast, sometimes unexpectedly, but history shows that recovery can also be strong. Today, systems exist to prevent similar events from spiraling out of control. For example, we now have circuit breakers, which pause trading if the market drops too quickly. These rules were created because of what happened in 1987. Another lesson is understanding the risks of automated strategies or investing without knowing what you're doing. In 1987, many people trusted portfolio insurance without really understanding how it worked. Today, beginners sometimes do the same thing with complex option strategies or margin trading on apps like Robinhood. These tools can be useful but also extremely risky if you don't understand them. Simplicity and long-term thinking often outperform complex strategies in the long run. As we wrap up, remember this: Black Monday was one of the fastest and most dramatic crashes in stock market history. But it also showed the power of resilience. Markets fall, but they also rise. History rewards investors who stay disciplined, stay educated, and stay focused on the long term rather than reacting emotionally to short-term fear. If you found this explanation helpful, make sure you subscribe for more educational videos. Educational purpose only, not financial advice.